Welcome to FXTech's comprehensive EUR/USD Analysis Report, covering October 27th through November 1st, 2025. In this presentation, we'll examine the critical technical levels, central bank policy decisions, and economic data that shaped the euro-dollar pair during this pivotal week. We'll provide you with actionable short-term and medium-term trading strategies, backed by thorough market analysis and risk management guidelines. Whether you're a day trader or a position trader, this report will equip you with the insights needed to navigate the current volatile Forex environment. Let's dive into the data and discover what's driving euro to US dollar right now. The EUR USD pair closed the week at 1.15349 on October 31st, marking a daily decline of 0.25% and a 5-day drop of 0.86%. The pair traded in a tight range between a high of 1.15773 and a low of 1.15215, with volume reaching 150,470 contracts. While the pair remains up 11.40% year-to-date, recent momentum has turned decidedly bearish. The weekly chart shows mounting selling pressure as the pair retreats from its October high. Technical indicators remain neutral, but the downward trajectory suggests sellers are gaining control. The chart clearly illustrates the bearish structure developing, with lower highs forming as resistance levels hold firm. Looking at performance across multiple timeframes reveals a mixed picture for EUR/USD. Short-term metrics show consistent weakness, down 0.26% over 1 day, 0.86% over 5 days, and 1.66% over 1 month. However, zooming out provides a different perspective. The 6-month performance shows a positive 2.07% gain, while year-to-date returns stand at an impressive 11.40%. The 1-year performance is up 5.99%. Technical analysis confirms that while indicators remain neutral, the recent price action tells a bearish story. The downward trajectory from October's high of 1.1917 signals mounting bearish momentum as sellers aggressively test critical support levels around 1.1540 and below. A critical technical development occurred this week. EUR/USD broke below the key 1.1540 support level, which had served as a double bottom from early October. This break confirms bearish momentum and opens the door for further declines. On the resistance side, we're watching 1.1576 as minor resistance, 1.1593 as a topside swing area, 1.1730 as a key resistance zone, and 1.1917 as the recent medium-term top. 1.1540 now acts as resistance after being broken. Below that, 1.1500 is a psychological level, 1.1390 is the initial downside target, and 1.1298 represents the critical 55-week EMA. This moving average is the line in the sand for the medium-term trend. On October 30th, the European Central Bank kept its 3 key interest rates unchanged. The deposit facility remains at 2.00%, main refinancing operations at 2.15%, and the marginal lending facility at 2.40%. The Governing Council emphasized that inflation remains close to their 2% medium-term target, with the outlook broadly unchanged. They acknowledged continued economic growth despite a challenging global environment, supported by a robust labor market and solid private sector balance sheets. However, the outlook remains uncertain due to ongoing global trade disputes and geopolitical tensions. The ECB maintains a data-dependent, meeting-by-meeting approach with no pre-commitment to a particular rate path. This balanced tone provided some stability to the euro but limited upside potential. Weaker than expected U.S. economic data throughout October solidified market expectations for Federal Reserve rate cuts. September's headline, CPI, rose 3.0% year-over-year, below the 3.1% forecast, while core CPI slowed to 3.0%, also below expectations. More significantly, August non-farm payrolls added only 22,000 jobs, far below the expected 75,000. June data was revised to show a decline of 13,000 jobs, marking the first contraction since late 2020. The unemployment rate rose to 4.3%, the highest level since late 2021. Markets are now fully pricing in a Fed rate cut, with 50 basis points of easing expected by year-end. This data initially weakened the dollar, providing a tailwind for EUR/USD. The Eurozone Centix Confidence Index plunged from negative 3.7 to negative 9.2 in October, well below expectations of negative 1.1, marking the weakest reading since April. Germany emerged as the clear weak spot, with investor confidence collapsing from negative 12.8 to negative 22.1. The current situation index weakened from negative 13.0 to negative 18.8, while expectations tumbled from positive 6.0 to just 0.8. This chart vividly illustrates the dramatic decline across all metrics. Contributing factors include persistent weakness in German industry, unfavorable tariff arrangements with the U.S., the ongoing war in Ukraine, and French political instability. This sharp deterioration in confidence added significant downside pressure to the euro. France faces a deepening political crisis as Prime Minister François Bayroul's minority government confronted an almost certain defeat in a no-confidence vote during our analysis period. This would mark the second government collapse in less than a year, following Michel Barnier's administration collapse last December. If the government falls, President Emmanuel Macron would be forced to appoint his fifth prime minister in under 2 years. This rapid turnover has severely undermined investor confidence and raised serious concerns about French fiscal credibility. The political instability in France, one of the Eurozone's largest economies, adds fresh downside risk to the single currency and creates additional uncertainty for euro-dollar traders. For short-term traders looking at a 1 to 2 week horizon, the bearish bias dominates. Our primary strategy is to sell on rallies toward the 1.1576 to 1.1593 resistance zone, targeting 1.1500 initially, with a secondary target at 1.1390. Stop loss should be placed above 1.1600, offering an attractive risk-reward ratio of approximately 1 to 2. For counter-trend traders, a long strategy could be considered on a bounce from 1.1540 support, targeting 1.1580 to 1.1600, with a stop loss below 1.1520. This offers a risk-reward ratio of about 1 to 1.5. Key events to monitor include U.S.-China trade talk developments, the Federal Reserve policy statement, and Eurozone economic data releases. Looking at the medium-term outlook over 1 to 3 months, we assign a 60% probability to the bearish scenario. This would be triggered by a decisive break below 1.1540 and the 55-week EMA at 1.1298, targeting a range of 1.1250 to 1.1390. The strategy here is to sell on rallies, focusing on the 1.1576 to 1.1593 resistance zone. The bullish scenario carries a 40% probability and would be triggered if 1.1540 support holds and the price breaks decisively above 1.1600, targeting 1.1750 to 1.1800. The critical level is the 55-week EMA at 1.1298. As long as this holds, the broader uptrend from the 2022 low remains intact. Risk management is crucial in the current volatile environment. First, implement strict stop losses. Never risk more than 2% of your account on a single trade. Second, practice proper position sizing by avoiding heavy positions in a single entry. Consider scaling into positions as trades move in your favor. Third, closely monitor news, especially ECB decisions, U.S. economic data like CPI and employment figures, and U.S.-China trade developments. Fourth, maintain flexibility and be prepared to adjust your strategy based on changing market conditions. The current environment is fluid, and rigid strategies may lead to losses. Upside risks include a more dovish Fed, positive trade resolution, and stronger Eurozone data. Downside risks include a hawkish Fed surprise, trade tension escalation, and further Eurozone weakness.